Our next guest, we'll see what he thinks, describes the current market environment as an unstable equilibrium and says the Fed's last three rate hikes were excessive. Joining us now for more, Barry Knapp, Ironsides Macroeconomics Managing Partner and Director of Research. Why do you say that, Barry? It seems like the economy has surprised everybody. We had Sternlicht on. Andrew, how long has Sternlicht been crying, singing the blues about the economy? And was it 6 months? Was it
18 months?
Was it horrible? What was he looking at? That seemed, consumers were tapped out. Everyone was borrowing. It's been strong, Barry. We've needed these rate increases to bring down inflation.
I don't really think the rate increases have had all that much to do with bringing down inflation in actuality. Most of the improvement has come from goods prices, which was supply chains. We've had a lot of improvement in energy that's lapping the whole Russian invasion. We had a lot of improvement in the core services, less rent of shelter. So Powell's whole thesis on what caused inflation when he gave that speech back at the end of November has no empirical support whatsoever. There was a big reallocation in the labor market, a lot of churn. When that was complete, wages just seemed to come back down towards their prior level. So I don't really think the Fed has contributed all that much to disinflation when you consider where they caused inflation was in housing, and housing is the piece that still hasn't corrected. But the unstable equilibrium piece is really about the banking system and the magnitude of the yield curve inversion. So I've actually been arguing, the equity market can work higher because the large non-financial corporate sector funds at the back end, those rates are relatively low compared to the front end. As Mike said, the economy can adjust to a 4.25% 10-year. And the household sector, which has termed out their mortgage debt, right, mostly owns 30-year debt. But it's the banking system and small businesses that are struggling with this yield curve inversion, which, we always talk about curve inversion and whether it forecasts a recession or not. But we've only had 3 in our history this deep. October of 73, December of 79, and December of 80. Deep recessions followed. I'm not arguing for that. I'm arguing that the curve needs to disinvert. The Fed's going to need to cut rates in the first half of next year, or the situation in the banking sector and the small business sector is going to get increasingly worse. And so that's the unstable equilibrium that I'm referring to.
So you figure Fitch is on to something with the bank. So that's sort of a, it's a nuanced view that you're taking. I mean, you can't blame the Fed, I don't think. Maybe they didn't have anything to do with inflation coming down, but when inflation is where it was and the economy is consistently staying as strong as it was every first Friday of the month with the labor market, what did you expect them to do? It's like almost like night follows day. You knew they were going to keep going higher with the economy not rolling.
I did, Joe, but what I wanted them to do early on, and I discussed it with you all as well on this, was they mostly eased by buying treasuries and mortgage-backed securities. That is, through their balance sheet. There was only 150 basis points of rate cuts during the pandemic-related easing. I wanted more aggressive action on their balance sheet and a little less aggressive action on the rate hikes so that they didn't cause this deep curve inversion that is essentially an existential threat to small community banks. So had they done this differently, we wouldn't have this curve inversion. And I think we'd be having we wouldn't have this unstable equilibrium. We wouldn't have this problem with small business credit.
So this is like the silent killer. I mean, we don't even see this underlying issue that you're talking about right now. But you say it's there. It's going to. How will we find out about it? How will it finally come out when it? Will there be something that breaks again?
Well, there's already been some evidence of it, Joe. There was a report a couple of weeks ago, the business employment dynamics, that goes back and really digs in on the labor market. It turns out that all the jobs that the birth-death model that's supposed to approximate small business employment created last year never existed. So it was originally estimated that something like 1.3 million small business jobs were created in 2022. Turns out that was like 60,000. So we're going to have a big, massive downward revision to last year's employment. And chances are small businesses are struggling far more than it appears based on this big macro data. So will that eat away at the foundation of the recovery and the expansion? Yeah, probably. Does it need to turn into a broad-based deep recession? No, as long as the Fed, gets us to this disinversion of the curve the right way, which is them reducing or reversing that, at least those last 3 hikes. And so, you guys were talking about Goldman Sachs forecasting cuts in the first half of next year. I absolutely think we need to see our way clear to that in order for the rally to push forward at the end of the year. The Fed needs to move the argument from, okay, we're tight here, but inflation's coming down. And Powell said it at the last press conference. He said, I don't expect to be tightening until we get to 2. In fact, I think we'll probably be easing before we get to 2. He doesn't think that's happening until 2025. I personally don't think inflation's going back to 2, but I do think they need to be in a position to reverse some of those hikes so that the curve disinverts and it takes the pressure off banks and small businesses. Later this year, the cuts need to come early next year.